Our final session is going to explore Resi, the African build-to-rent market, a new investor priority, exploring multifamily and build-to-rent options, understanding the numbers, dynamics, and expanding market in Africa. The session will be moderated by Palesa Mkhize, CEO of Samra. Palesa's panelists can make their way to the chairs, please. Do you have enough chairs? Yeah. Please. Please, huh? We're going to try and keep to, I think it's 30 minutes because we just, it's late. Okay.
Sorry, we're just missing one panelist, Bernard de Jong from IHS. And he appears. Good afternoon, everyone, and thank you for being with us in the graveyard shift. My assumption is you really want to be here and you really want to hear what we have to say. So we'll try and make it as engaging as possible and hopefully keep you wide awake. I've seen some nodding heads, so let's get it going. As Ash mentioned, I'm Palesa Mkhize and I'm CEO of an organization called Samra. It's a mouthful, the South African Multifamily Residential Rental Association. Fairly young, launched in about February of 2024. And I am here representing about 40 billion rand of assets, 75,000 housing units, all built in what we call multifamily. And by multifamily, we mean, institutional ownership, full-on amenities, and in this instance, rental. Our members are the likes of House by Century, Diversity, the Central brand from Cosmopolitan, Live Easy, the guys at AFCO. So there's a whole host of them. We're currently sitting at a membership of about 15. The banks have also become members. Standard Bank is a member, ABSA is a member, Nedbank is a member, and these are the real estate finance teams within the investment banking divisions. Today's conversation is going to be largely around what it is these various institutions do in order to help scale this subsector of real estate. Residential is this weird little niche where it's a social good, and then it's a highly commercial good. Seen by what Airbnbs are doing in the Atlantic seaboard, there's bucket loads of money to be made in the subsector of real estate. And as Samra, the idea is that we'd like to see more institutional investment happen within residential. And when we say institutional investment, we're looking at your DFIs, your pension funds, etc. And the only way that happens is if we create more transparency. We'll touch on that in the panel later on. But to kick off, I'd like to give you a sense of what multifamily is. I had a presentation done, but today is not the greatest take day, it seems. So we'll go ahead without it. And it's just a few slides on what multifamily looks like. First of all, I'm going to go to Sam over here from Mavida, and I'll give you my mic, Sam. I'll give you my own. We'd like to talk a little bit about what multifamily looks like or what built to rent looks like. Sam, could you give me a sense of what the Kenyan market or what the Kenyan product looks like?
Thank you. My name is Sam, CEO of a platform called Imivida Homes, one of a handful of institutional developers in Kenya. We don't have many. I think we have less than 10, what I'd call institutional quality residential developers in Kenya. The country, probably just like most of the continent, is very much a rental market. If I look at our urban centers, I would estimate it's 80 to 90% rental for a multiplicity of reasons. Mortgages is bloody expensive. There's always been double digit. There are a lot of cultural factors, and I suppose statistically, majority of the population earn less than $1,000. So home ownership is more of a want. It's not a need. And therefore, if you look at most of urban centers led by Nairobi, and I suppose this speaks to the wider East African cities, you have a lot of what I would call very substandard informal stocks owned by small landlords, largely walk-up apartments, ground plus 4, ground plus 5 walk-up apartments. Even we, as developers, much as we call ourselves homes developers, strictly speaking, what we sell are investments. And I say that because majority of our buyers would be you and I buying a residential unit with the purpose of renting it out. So you have, on one side of the scale, you have developers. In between, you have what I would call maybe high net worth or middle class investors who buy apartments and rent out. So strictly speaking, what I would call institutional build to rent doesn't exist, certainly not at the scale that one would see in a more developed market like South Africa. Even though, the form factor of it is that, majority of the stock in the market is for rental. The question then is how do we fund it? If on one side I'm building with what I would call a very impatient capital, selling to you to rent out, how do we, then fund? And the funding structure then, right from the land acquisition itself, it takes mostly JV forms. You don't want to deploy a lot of your capital to land acquisition. When it comes then to selling the residential units themselves, outside of very few sort of bulk institution offtakes, we have what we'd call payment. We sell off-plan. Majority of the developers would sell off-plan. You have a particular threshold that you must pre-sell for you to break ground. And the payment plans are such that, the customer pays throughout construction. If you are well reputed, if you have a good sales infrastructure, an ideal situation is where 100% of your hard costs is actually funded by customer deposits. So from residential developers then, from an equity RL perspective, it's very lucrative. But when you then offload to individual investors, typical yields are roughly 8 to 10% for residential. Recently, we have this new emerging class of student housing, and there we are seeing a bit of double-digit yields. But when I say emerging, it's really just one operator. So I suppose, relative to more developed market like South Africa, it's still a very developing market, a very uninstitutional. Most of the stock is largely very, very informal. And therefore, there's a huge sort of opportunity to institutionalize. Yeah.
Thank you very much, Sam. I think that gives us a bit of color for what the East African market looks like. On our panel, we also have Bernard from IHS, and they are in Botswana and Namibia and a little bit of Kenya as well. So, Bernard, just maybe on the back of that, could you give us a sense of what build to rent looks like in those regions? And, has IHS always wanted to do build to rent? And, how do you guys structure the funding for these things?
Thanks, Belisa. If one day I could just be late for my funeral as well, I'll be a very happy man. So I think when people hear multifamily build to rent, the mind often wanders to, something that's sort of rundown apartment block with overcrowding and non-payment issues, where, you know, in the institutional case in the build-to-rent market, that's not at all the case. You know, all of our funds and funds of our peers come with institutional capital that back the investments. They're all professionally managed, and generally people collecting up to 98% of the rentals that they bill, and you're sitting with like less than 4% vacancies. So it ultimately provides for a very predictable inflation-linked income stream, which banks can easily put money behind, as well as pension funds. And I'll use that a little bit later as well when I speak to the funding and the structuring. In terms of the projects themselves, I think there should be some slides playing. Okay, it's been, all right, I'll try to use my words to describe what the properties look like. Across Namibia, Botswana and South Africa, the product type is very similar. So we try and do like a 4-story walk-up block with a host of amenities included in the development. So it offers residents with a real strong sense of community. All these assets are strategically located sort of close to schools, healthcare and work opportunities. Historically, our model first started with sort of a build to sell sort of motion. But in our first fund, which launched just sort of after the global economic crisis, we were almost forced to look at, you know, what's the alternative to selling these assets we've already built. And I think that's where our journey in the build to rent had really started. It's proved to be a way more predictable and resilient sort of asset class. In Kenya, we've done one project with Sam and his team, a beautiful scheme in Garden City. So there the product is slightly different because of your expensive land and scarcity to land availability. We're forced to do high-rise. Obviously, across all these countries, local materials sort of dictate what it looks like. In terms of transaction structuring, so obviously we manage private equity funds. A lot of our capital comes from DFIs and pension funds. So we use the fund equity to finance part of the developments, and then because of the predictable income streams, it's really easy to raise commercial debt. After the development phase, we generally convert to term loans that are interest only. And the trend definitely seems to be to sort of structure that's very similar to a REIT-like structure that's very popular in the States. With our investors coming from DFIs and pension funds, we set it up so that you've got vesting trusts which ultimately hold the assets, and that allows us to distribute the income from the properties directly to these investors in a very tax-efficient way. Yeah, that's about all I've got.
Thank you very much, Bernard. I think we've got a bit of a sense of what the landscape of build to rent looks like on the continent now. And what I'm really interested in is maybe tapping into more of this funding that Bernard was referring to. We've got Standard Bank on the end there, and my question to you is, you know, what do these funding structures look like? If Bernard's bringing all the equity, what are your terms to participate in these build-to-rent transactions, and how does the bank view the sector?
Thanks for the question, Balisa. So, hi everyone. My name is Mncedisi Dumse. I'm part of Standard Bank. I look after the East Africa business for real estate finance. So when it comes to the funding structure, right, markets differ. So as Bernard said, you know, more the southern markets are quite mature. So how that capital stack tends to stack up is you have a fair share of equity and you got a bit of debt into it, and you can find anything up to 60% of the cost. But how we put our funding structures together is all cash flow driven, right? So it's what the cash flows can afford, and those go in to see when it's at a certain level of occupancy. If it's a build-to-rent product, how would that afford its debt, and then that's how that's funded. But when you start looking at other markets more in the West and East Africa, given that the retail mortgage market is not as mature as the southern parts of the continent, the capital stack is more shared with pre-sales. So there's not a big rent to build market in some of those markets. The opportunities we've done historically were corporate accommodation, where you would put up a structure to get equity from the developer, the bank would fund, and then you would have a long-term lease with the corporates. But when we start going into the retail markets, a lot of those trades are sold, like Sam mentioned, because there's not the mortgage market at double-digit interest rates. So what you then find is that the rental market is owned by individuals such as ourselves and not necessarily the banks. And when that's the case, your gearing then again goes back to cash flow. So can you, to Sam's earlier point, the developer put in equity that could be 20, 30%, and then the balance of the capital stack will be split between your debt and your pre-sales income. And you'd obviously then look at the location, see what makes sense, how that node kind of behaves. And that's how we typically structure the build-to-rent in that space.
Thank you very much. It looks like it's a hodgepodge of structuring depending on where you are in Africa. I think we've discussed a bit in terms of the commercial structures that come with doing build to rent. But Balasa, DBSA, you've got a bit of a developmental mandate. And in South Africa, there's a burgeoning new area called, upcoming developers, or, I don't want to call them, So maybe tell us a little bit about how, on the developmental end, you view things like social housing and backyard rentals, etc., because that too is a form of rental housing.
Great, thank you. My name is Balisa Ryan, like you've mentioned, from the DBSA. I sit in the part of the bank called Coverage and Deal Origination. The DBSA is well known for being a funder of economic infrastructure like energy projects, water, roads, but little known fact is we also do social infrastructure, and that would be funding projects in housing, affordable housing, education, as well as healthcare. So it speaks to that whole, I suppose, integrated approach in terms of, facilitating people being placed. And when we then get closer to the work that we've done, we've historically relied on being an intermediary funder. I've got some clients on the panel with me. We have a line of credit out to NHFC, as well as the Trust for Urban Housing Finance, who do developments in the inner city. Recently, just concluding a deal as well with IHS, and looking to expand on their work into Botswana as well. But we found that the need is so massive that we have to move further down the developer stack, as it were, to start borrowing directly to the developers. To that end, we work quite closely with SHRA, that's the Social Housing Regulatory Authority of South Africa. They're an agent of the Department of Human Settlements, and they provide 70% grant for the funding of social housing, which is rental housing stock. And what's great about this product is that it pegs rental prices at an affordable level, because depending on who you speak to, especially for for sale market, affordable housing differs. I know when you wore your Stand Bank hat, you used to think that 1.2 million was affordable housing, as an example. So we really do look to that sector of the market to keep rental prices low, especially because we do consider that in urban cities, about 60% of the population is accommodated via rental stock and not actual home ownership. So in these spaces, we look a lot to relying on the experience of the providers of the housing, as well as the regulatory authorities that may be in place, depending on that. And this is where we see the role of organizations like yourselves, Balisa, being important, because information tends to be quite opaque. And on the other side, of course, you've got myself and my team, I'm not alone, who want to write the deals. But on the other side, we've got your investment and credit committees who are quite skeptical about this asset class. Like Bernard mentioned, people think it looks like funding shacks or funding developments on top of each other which aren't dignified. So when we look at these projects, we look at people who have experience in the sector, we look at regulation, we look at occupancy rates as well as the availability of dignified social amenities, and of course the price point being an enabling factor as well, to keep people close to places of employment as well as schools.
Wonderful. Thanks, Balasa. That's a good story to tell. George, I believe you also have a good story to tell. NHFC also looks at the lower end of the market when it comes to rental, and you've got some interesting divisions and structures in order to execute your mandate.
Yes, good afternoon, everyone, and thanks, Balisa, for the question. Yes, I think the NHFC is in a unique space because we are mandated to serve a particular market. And that on its own brings a lot of challenges because, as you know, we operate to serve the low to middle income. And we have a cap that we've been given by the shareholder, which is the National Department of Human Settlements, that we need to serve the market that ends between 3,500 and 22,000. So our engagement with developers, it would always be that when they come through to us for financing, they have to serve that market, right? So it is a mandate. And I'm going to come to how it is sort of like giving us a number of challenges in the market when it comes to the new entrants in the market that are providing the same products that we meant to provide to that income group. Yes, we are very strong in rental, in private rental. We are very strong in student accommodation, and we are very strong in partnerships. Where the NHFC cannot reach. For example, we are in partnership with TEF. We are a shareholder at TEF, where we partnered because we know that TEF has a competitive advantage of reaching out to where we cannot reach out. So the inner city regeneration programs, where you engage with entrepreneurs that would like to start with small projects, in the inner city, where the NHFC, because it's a national DFI, we miss those little pockets, because we tend to attract big developers that are really not much into regeneration in the inner city. They want to do greenfields projects that cost hundreds and hundreds of millions. So our strategic partnership with the likes of TEF actually make us even penetrate or extend our mandate to the areas that, as NHFC, we would not reach. So it is a very good story to tell because when we look at the impact that we have had through that partnership, it is immense, and we are beginning to see the numbers flowing into our APPs when we report, because that also helps us in our numbers, and we are shining through those partnerships. I think that, for me, that's the key thing. But I also want to bring something interesting. I was talking to my colleague and we're looking at our portfolio, and I was saying to him, it is very interesting that our portfolio is tilting towards rental. Currently, we have about 60% of our loans sitting in rental. And I was looking at the pipeline that we have right now that is currently on due diligence. It's 60% of investments that are coming through rentals. So then you ask yourself a question, because NHFC is not only in rentals, we are also in sales. So you find that the sales package is now suffering, because I think we were looking at an analysis and we found that each time there is a high interest rate environment, people tend to move towards rental. And then when interest rates go down, hopefully today there might be just another relief. And then people gravitate towards sales. But the challenge that we have there in the sales is that the developers in the sales space, they are faced with a lot of headwinds. The cost of developing for sales, the pre-sales requirements from the NHFC are stringent. And that's why we are now getting a lot of people moving towards rental, and that's where we are really playing a lot we're providing a lot of investments in that space. So for institutional financing, we are of the view that that becomes an extension of our mandate as well. You know, the likes of IHS2, where we've partnered, the likes of Early Roads, you know, they came in 2010 applying for only 32 units, and then now they have a target of about 22,000, and we have been involved with them throughout. You know, so each time we put in our investment, it also attracts other private sector investors that come in and they put in, because we have already de-risked. Some of them we know that they would not have gone in there if NHFC didn't go. So we come in, we de-risk, other people see the opportunity, they come in. And we're not jealous. We believe that with the 2 million housing backlog in South Africa, we cannot just as NHFC resolve that. You know, we need the likes of DBSA, we need the likes of ITC, we need the likes of, you know, PIC to come in and have a big slice of this cake. Yeah, I will end there. Thanks.
Thank you very much, George. Ash is going to start winking at me to say I must wrap things up. But I think we'd be remiss without mentioning that, you know, some of the key unlockings we've seen in the sector of late have been the likes of what they called the 4 o'clock brain now. The Market Accelerator for Green Construction, which is IFC's magic program. You know, they've pumped billions into the banks for us to, you know, I say us, my former life was as a banker at Standard Bank. We've put that money back into developers' hands because that was a grant awarded to developers to build green. But ideally what it did is, you know, it increased the number of units we saw in the market. And one other very important thing that I think I should mention before I dash off is the fact that earlier JLL spoke about how transparency increases investment. And that's one of the big things we will be focusing on at SAMRA. We've published, if anyone picks up Rhoda every quarter, you'll see this quarter we've got a SAMRA chapter, and we've had about 50,000 units surveyed, and it was interesting to see how institutionally owned properties performed better than your moms and pops. And that's simply because when property management is institutionalized, it comes with great experience and the amenities as well. That's going a really long way at retaining end users, or in this case, tenants. So there are a few key things that are becoming quite pivotal at seeing us get to an inflection point and seeing multifamily become something quite serious in this end of the world as well. Because what we see from a data perspective is that multifamily is quite a staple in real estate investment in the rest of the world. And we'd like to see multifamily kind of lift a few notches in Southern Africa. I'm going to stop talking because Ash is looking at me with a side eye right now. But thank you for your time, and thank you for seeing us through this graveyard shift. We really appreciate it.
Okay.